Welcome and thank you for joining me for today's educational class. My name is Joseph Budd and I'm a certified financial planner and managing director with Budd Wealth Management. We have developed and refined our client life process over the last 20 years that work with families that aspire to a work optional lifestyle. We hope to put all the pieces of the financial puzzle together for our clients. Connect with us on LinkedIn and Facebook, where we post interesting personal finance content and invitations to future events like this event on a regular basis. Also, visit us at budwealth.com. This session is being recorded and you will receive a link to the recording in a follow-up email. LPL Financial presents Outlook 2026, the Policy Engine. This presentation is not meant to try to predict the future. It's a way of approaching a new year, reviewing the conditions that are present and looking at how these conditions have previously affected markets. A sound way to approach each new year is by updating your financial plan, making sure that your goals, cash flow needs, whether in the present or in the future, are included in your planning. I hope you find this content of interest and the perspectives today that are shared helpful. The economy. The more things change, the more they stay the same. While the U.S. economy should be sluggish in the first half of 2026, it's also expected to avoid a full-blown recession due to the tailwinds of easing monetary policy and business-friendly dynamics within the One Big Beautiful Bill. The lagged effects from a slowing job market, softer wage growth, and nagging inflation will dampen growth in the first quarter of 2026. But as businesses and households regain their footing from uncertainties during 2025, we expect 2026 to grow close to 2.1%, higher than 2025, but not as fast as 2024. Fiscal spending and strong business investment in artificial intelligence, or AI, infrastructure is expected to provide crucial support for the economy. The insatiable demand for cutting-edge technologies like data centers, advanced semiconductors, and AI-driven software is fueling significant capex by tech giants and businesses across various sectors. The demand for artificial intellectual property, IP, will be a pillar of growth, and we expect IP will have an increasing slice of the economy. Inflation will not likely decelerate as fast as policymakers would hope, yet still expect the Fed will continue its rate-cutting campaign in 2026 as it balances inflation concerns with risks to the labor market and overall economic growth. Ongoing factors such as new tariffs could push general inflation slightly higher, but softer household demand will cause inflation pressures to recede in 2026. But in the near term, investors will have to bear the burden of hotter inflation. Mortgage rates are primarily influenced by long-term interest rate dynamics, which are shaped by the fiscal outlook and the 10-year U.S. Treasury yield rather than just the Federal Reserve short-term policy rate. When fiscal policy results in large deficits and heavy Treasury issuance, investors often require higher yields to compensate for increased supply and inflation risk, pushing mortgage rates higher. But 2026 should be a year of declining mortgage rates, creating some support for home buyers. Geopolitical and trade uncertainty will stunt the Eurozone's economic growth. High relative energy costs coupled with broader structural weaknesses in productivity and technological capacity limits the Eurozone's international competitiveness and risks constraining growth below U.S. levels. Plus, many member states are implementing fiscal tightening measures which act as a drag on growth. Japan's goal of the virtuous cycle of sustainable inflation driven by robust wage growth looks more likely in 2027 than in 2026. The nagging questions for investors are the pace of future rate hikes and the timing of the terminal rate, which is complicated by ongoing global economic uncertainty and the government's desire to support growth. Stocks, policy tailwinds, and AI to power equities in 2026. The S&P 500 surged more than 80% over the first 3 years of this bull market, excluding dividends, far outpacing historical averages. If history is a guide, then this bull may have more room to run. The S&P 500 has averaged 12.8% gain historically during the fourth year of bull market since 1950, with 6 positive years out of 7. In previous instances when the Fed cut rates when stocks were at or near record highs, 28 cases, the S&P 500 was 13% higher on average 12 months later, with 93% of those 28 periods producing gains. When the U.S. economy was not in recession around a rate cut, the average 12-month return for the S&P 500 increased to 18% with gains in all 21 periods. Consensus estimates for 2026 CapEx from the 5 hyperscalers is expected to approach $520 billion, a roughly 30% increase over this year's estimate and an estimated 1.6% of the U.S. economy measured by nominal GDP. In terms of dollars, that can help drive the economy and corporate profits. Nothing is bigger than AI right now and is very unlikely to change anytime soon. The Magnificent Seven has been responsible for more than half of the S&P 500 earnings growth the past few quarters, and will likely continue to play a significant role in growing earnings in 2026. The wide gap between the Magnificent Seven's earnings growth and the rest of the market will likely persist well into 2026, supporting large cap growth stocks, but monitor the gap potentially narrowing. Midterms. Regarding midterms, the Republican majority in the House is razor thin as they hold just 219 seats, one more than the 218 needed for control. This represents the slimmest margin since 1931 and significantly increases the risk of a shift in power next fall. In 20 of the last 23 midterm elections, the president's party has lost seats in the House, with an average decline of 27 seats. Historically, midterm years have been challenging for equities. Since 1950, the S&P 500 has averaged a modest 4.6% gain during midterm years, with an average maximum drawdown of 17.5%, making it the most volatile and weakest performing year in the 4-year presidential cycle. Once political uncertainty subsides, markets tend to rebound. Bonds navigating neutral. Market pricing suggests that the Fed's rate-cutting campaign could end by the second half of 2026 with a trough rate of around 3%. If market pricing is right, it's likely that the 10-year Treasury yield will remain around 4%. It's unlikely the Fed will cut rates to levels that would take the 10-year Treasury much lower. Thus, we think a 3.75% to 4.25% 10-year Treasury yield range for 2026 is appropriate, at least for now. Upcoming, likely dovish changes to the FOMC should help prevent the 10-year yield from drifting meaningfully higher. Despite recent challenges, the broader credit market is not in crisis, nor do we think we are on the cusp of systematic credit issues. Our issue is with market valuations. Credit spreads, or the additional compensation for owning risky debt, remain historically tight given these rising idiosyncratic risks. While yields may appear attractive, spreads remain below longer-term averages and are arguably not providing sufficient compensation to take on these emerging credit risks. Agency mortgage-backed securities and investment-grade corporates should outperform Treasury securities given the higher starting yields for both asset classes, but given our view on rising idiosyncratic risks within the corporate credit markets, we still have a marginal preference for mortgage-backed securities over corporates. As the Fed continues to cut short-term interest rates, cash yields will come down as well, which should allow high-quality fixed income markets to outperform cash holdings once again. A stable or slightly higher interest rate environment and even tighter spreads are needed for high yield and leveraged loan sectors to outperform core sectors. Merger and acquisition activity has been trending up both in terms of the number of deals and the value of the deals, supported by the deregulatory policies, rate cuts, and increased demand in AI-related transactions. You will all receive a link to our resources page where you can access and download the full Outlook 2026 report to read at your leisure. There will also be a link to schedule a follow-up meeting to ask any further questions about today's presentation. Thank you for attending Outlook 2026. Thank you again for attending. You can email me at jbud@budwealth.com with any questions. Have a great rest of the day and a wonderful 2026.